Hi everyone. Today we're going to be talking about retirement and estate planning. Retirement planning is about preparing for the time when you stop working full time so you can live comfortably and maintain your lifestyle. It's not about being idle or no longer useful. Retirement is just a transition to a different phase of life where you can still contribute in many ways, like helping family, volunteering, or even starting a small business. Estate planning, on the other hand, is about making sure your assets like savings, house, and investment are managed well while you live and pass on to the people you want when you're gone. It ensures your family or loved ones are taken care of and avoids unnecessary problems after you pass away. By planning early for both retirement and your estate, you can secure your future, reduce stress, and have peace of mind knowing that your hard work will benefit you and your family. Retirement. When people hear retirement, many think it means stopping work or being useless. But that's not true. Retirement is just means you don't work full time anymore, but you can still be productive and enjoy your life. In the Philippines, some people dream of retiring at the age of 50 instead of 60. The earlier you retire, the more money you need to save, and the earlier you should start. You will need to save more money each year because you have fewer working years or fund your retirement. Starting early years allow you to save smaller amounts that grow over time. An example for this one is Tito Juan, an OFW from Riyadh, Saudi Arabia. He wants to retire at the age of 50. If he hasn't started saving, he might struggle to support his family back home in Dumaguete City. But if he saves even 5,000 pesos a month, starting now, it can grow into a fund that can start supporting him. Another example is Angel, a sari-sari store owner earning 15,000 pesos a month. Start saving 1,000 pesos a month at the age of 25. By 60, she can combine her savings with a small vegetable garden or renting out a room to supplement her income and enjoy retirement comfortably. The key takeaway in this is retirement is not the end of your usefulness. It's a transition to a new phase of life. By starting early, even with small savings, you can secure your future and live comfortably during your retirement years. So why plan your retirement? It's never too early to start. First, it's never too early to start. The earlier you start saving and planning, the more prepared you will be in the future. Planning your retirement helps in several ways. Number one, handling unexpected changes in life. Life can be unpredictable. You might face emergencies, health issues, or other financial challenges. Having a retirement plan gives you safety net. Number two, gives you a sense of control over your future. When you plan, you know what steps to take to reach your goals. It reduces stress because you're prepared instead of just hoping things will work out. Number three, make your retirement years more comfortable. Saving and investing early means you can maintain your lifestyle after retirement without worrying about money. An example that we have is Joseph, a teacher who decided to save 2,000 pesos every month, starting at the age of 25. By the time she retires at 60, that small amount has grown into a large fund, giving him a financial security and a peace of mind. Another example that we have is Liza, a sari-sari store owner that saves just 1,000 pesos a month. With consistency, saving a small side of business, she can cover daily expenses and enjoy her retirement comfortably. The key in this is even small savings can make a big difference later. Starting early is the secret to a stress-free and secure retirement. Planning your retirement income. Security Services or Social Security provides benefits to retirees, survivors, and people with disabilities. In the Philippines, private sector workers receive benefits through SSS, while government employees receive them through GSIS. However, it is important to remember Social Security alone is not enough to cover all your retirement expenses. You will still need personal savings or investment to maintain your lifestyle. An example that we have is teacher Maria. She receives 10,000 pesos a month from SSS. This helps pay for the basic expenses like groceries, utilities, but still, she needs to use her personal savings for extra costs like medical bills or travels. Another example is Tito Juan, an OFW. Combines his social security benefits with retail funds, investments to live comfortably after retirement. Another thing that we have to remember is this: Social Security helps, but your own savings are essential for a secure and comfortable retirement. Now, let's talk about the limitations of Social Security services. When planning your retirement income, first, Social Security was never meant to cover 100% of your retirement needs. It provides basic support, but not enough to maintain your full lifestyle after you stop working. Second, future changes to the program will reduce the benefits you receive, so the amount that you get becomes smaller than expected when you retire. An example that we have here is a teacher. Let's name her Carol. She qualifies for SSS. The pension only covers part of her monthly expenses. She will still need her own savings and investment to pay for extra costs like healthcare or travel. Another example that we have here is Lyndon. He is an OFW. He knows that government program may change, and he also invests in mutual funds and secure his retirement income. He also started to invest in insurances. What we have to remember is that Social Security helps, but you should not rely on it only as a source of retirement income. People's savings and investments are essential to live a comfortable life. The government's goal is to create a tax-exempted security social services that meets the needs of all Filipinos. The system is designed to promote social justice through savings and provide financial protection to members and their families. Social Security benefits helps during situations such as disability, sickness, maternity, old age, death, and other events that may cause the loss of income or financial hardships. An example that we have here is a factory worker who becomes disabled and can receive Social Security benefits to help pay the medical expenses and living benefits. Social Security is not just retirement money. It's a safety net that protects you and your family during life's unexpected events. Under Republic Act 7641, also called Retirement Pay Law, employees who retire are entitled to receive at least half a month's salary for every year of service. If an employee has worked for at least 6 months in a year, it is counted as a full year. So what does half a month's salary include? It is made up of 15 days of pay, 1/12 of the 13th-month pay, cash equivalent of up to 5 days of a new service incentive leave. To qualify to this benefits, an employee must have at least 5 years in the company, must have reached at the age of 60 years old. An example that we have here is teacher Carla, who has worked for 10 years in her school and retires at the age of 60. She will receive at least 10 half-month salaries as her retirement pay, including 15 days of pay, a portion of her 30th month, and may unused services and incentive leaves. RA 7641 ensures that long services employees are rewarded for their years of service, giving them financial support during retirement. According to United Nations population found in 2018, the average life expectancy of Filipinos is about 71 years old. In 2018, the average annual family spending was around 238,641, which means a person needs to earn about 18,167,000 per month just to cover basic family needs. So, how do you prepare for retirement? Here are some steps. Number 1, plan ahead. Start saving and investing as early as possible to grow your money over time. Number 2, protect your money. Use tools like saving accounts or investment linked life insurance or VUL to secure your family and your financial future. An example that we have here is teacher named Carol. Carol saves a portion of her monthly income and invests in a VUL plan. By the time she retires, she has built a fund that can support her family and herself comfortably. The earlier you start planning and saving, the more secure and comfortable your retirement will be. Let's talk about how to strengthen your retirement fund. There are key steps for this one. First, spend less now and save more. The more you save today, the bigger your fund will be in your retirement. Number 2, invest wisely for better returns. Choose investments that give good after-tax return to grow your money faster. Number 3, work longer if possible. More years of earning means more savings and a bigger retirement fund. Saving an extra 2,000 pesos per month and investing it wisely can grow into a substantial fund by the time you retire. Thing that you have to remember is that small steps taken today can make a big difference for financial security in the future. How much do you need for retirement? Most financial advisors recommend having 70 to 80% of your final monthly income to maintain your lifestyle after retirement. Your retirement needs depends on your lifestyle. If you love traveling, you'll need more than 80% of your current income. If you prefer a simple life, maybe less than 70%. The tips that we can give you here is save at least 15% of your income. Pay off your home before retirement and don't assume future expenses will match today. An example for this one is if you earn 50,000 pesos per month before retiring, you would need around 35,000 pesos to 40,000 pesos per month during retirement to maintain your standard of living. The key point to remember is that planning your retirement income helps you maintain your lifestyle and avoid financial stress. Financial advisors suggest aiming for around 65% of your pre-retirement income if you've been saving steadily and planning carefully. Here are some tips for retirement planning. Number 1, save a large portion of your income. Aim for at least 15% of your earnings each year. Number 2, high income earners. You may need to save even more to maintain your lifestyle. Number 3, pay off your home. Try to own your home free of debt before retirement. And number 4, plan realistically. Don't assume that your retirement expenses will match your current income exactly. An example that we have here, if you earn 50,000 pesos per month, save at least 7,500 pesos for each month and aim to pay off your home before retirement. Things that you have to remember is that early savings, smart planning, and being debt-free are essential for a secure and stress-free retirement. If you want to maintain a lifestyle similar to your current one, financial advisors suggest aiming for around 75% of your pre-retirement income. Here are some tips to remember. Number 1, save reasonable portion of your income. Aim for 5 to 14% of your earning each year. Number 2, consider mortgage for rent. You may still have some payments to make for retirement, so plan accordingly. Number 3, maintain your lifestyle. Expect to have standard of living similar to your current lifestyle. If you earn 40,000 pesos per month, save around 2,000 to 5,000 pesos each month to help maintain your lifestyle. In retirement, even if you still have mortgage payments, you have to pay for it. Another example is Anna, a government employee which saves 3,000 pesos a month and keeps her small condo rented out. This rental income helps her cover expenses while maintaining her current lifestyle during retirement. You have to remember that consistent saving, planning for debts, and generating extra income are crucial to secure a comfortable retirement. In this case, financial advisors suggest you would need around 85% of your pre-retirement income. to try to maintain your lifestyle. But this can be very difficult if you haven't saved enough. Consider these points. Number one, low savings. If you save very little or nothing from your income, your retirement fund will be small. Number two, mortgage or rent. You may still have large mortgage payment or high rent that needs to be paid. Number three, lifestyle expectations. Expecting to maintain your current lifestyle without saving can be challenging. If you're earning 30,000 pesos per month but save a very little amount of money, you might struggle to pay your mortgage and cover daily expenses after retirement. Another example that we have here is Mang Tonyo, a small business owner. Didn't save much while working. When he has to retire, he had to continue working part-time to just cover his rent and basic living expenses. One thing that you have to remember is that saving consistently, even in small amounts, is much better than waiting until it's too late. Now let's talk about what to do if you started saving late or want to boost your retirement fund. Even if you didn't save much earlier, there are ways to make up for lost time. Number one, question your spending. Cut unnecessary expenses to save more. Number two, use your home equity. Consider downsizing or tapping equity from your property to fund your retirement. Number three, grow your investment. Invest wisely to increase your retirement savings. Number four, be realistic with your retirement age. Working a few more years can significantly increase your saving. Number five, turn hobbies into income. Skills like baking, tutoring, or crafting can become small businesses that add to your retirement fund. Number six, consider inheritances. Factor in potential inheritances, but don't rely on them entirely. Selling or renting a part of your property can provide extra funds for retirement. An example for this one is Margaret. Margaret loves baking. She starts selling cakes and pastries, and the extra income goes directly to her retirement fund. One thing that we have to remember is that it's never too late to take action. Smart planning and creating ways to increase income can make a big difference in securing your retirement. Estate planning. This is a process of planning how to manage and use your assets while you're alive and ensuring they are distributed according to your wishes after your death. An estate includes everything you own, your house, savings, investment, and other property. So why is it important? Most people want to pass their wealth to loved ones. Estate planning ensures that your assets go to your family or choose beneficiaries smoothly and according to your wishes. An estate includes all the property and assets a person owns, like your house, savings, investments, and other belongings. The purpose of estate planning is simple. Most people want to pass their wealth to loved ones. Proper planning ensures your assets are distributed smoothly according to your wishes after you pass away. By creating a will or trust, you can make sure your house, savings, and investment go to your chosen beneficiaries without disputes. An example that we have here is Mang Juan. A retired teacher writes a will specifically that his savings and small property goes to his children. This prevents delays and confusion to his family. One thing that you have to remember is that estate planning protects your family and ensures your assets are managed wisely. Let's continue the estate planning, which is a key part of retirement and financial planning. One thing that you have to remember here is that building your estate. This is all about growing your assets while you're alive. You can do this through number one, saving, putting aside money regularly. Number two, you have to have investments, stocks, mutual funds, and other financial instruments. And last is insurance, life insurances or investments linked plans. An example that we have here is teacher Maria that saves a portion of her salary every month and invests in mutual funds and has a life insurance. Over time, she builds a solid estate to her future life and her family. Another thing is that distributing your estate. This ensures your assets go to the people you find or you have chosen when you have passed away. A beneficiary is a person named to receive a part of your estate. An example that we have here is you can name your children as beneficiaries for savings account or life insurance policy, so they receive it according to your wishes. One thing that you have to remember is that building your estate now and planning how it will be distributed protects your family and ensures your wish are followed. Estate plan documents include legal papers that explain how your assets will be handled after your death. One of the most common document is a will, which is a legal statement of your wish for distribution of your estate. A will can specifically who gets your house, savings, or personal belongings, ensuring your estate goes to the right people. Reviewing estate documents is just as important. All your estate papers must be checked and verified before your heirs can claim your assets. Why does it matter? If documents are missing or incomplete, your heirs may face delays or even legal disputes. If a will is misplaced, it can take months or even years for your family to access your savings and property. We have to remember that keeping your estate documents complete, updated, and a safe place ensures smooth transfer of assets to your loved ones. Let's talk about dying intestate, which means when a person passes away without a valid will. If this happens, the law of your residence will decide how your estate is distributed, without considering your personal wishes. If you have been saving for a property but didn't create a will, the government may decide which family members inherit your assets. This means not much what you actually wanted for your loved ones. The key point is having a valid will is crucial to ensure your assets to go to people you choose and to avoid disputes or delays of your family. Continuing with estate planning, let's discuss about probate, which means it is an important legal process. Probate is a process or procedure that used to verify whether a will is valid or not. It also ensures that your estate is managed and distributed correctly according to your instructions in your will. A specific probate court oversees this process. The court validates a will, which makes sure that debts are paid and supervises the distribution of your assets to your beneficiaries. An example is Mang Juan left while naming his children as beneficiaries. The probate court ensures that his debts are settled first, then saving his money and property are distributed to his children as stated in his will. One thing that we have to remember is that probate protects your estate and ensures your will and wishes are legally carried out, giving your family clarity and security. Writing your will. Now let's discuss about writing your will, an essential part of estate planning to ensure your assets are distributed according to your wishes. Here are some important guidelines. Number 1, work closely with your spouse or partner to prepare your will. Number 2, write your will to confirm to your current wishes. This should actually match what you truly want today. Number 3, do not choose a beneficiary as a witness. This will actually prevent any conflict of interest. Number 4, consider signing prenuptial agreement if you are remarrying. Number 5, consider using percentages instead of amounts. This is to make adjustment easier in the future. Number 6, if you are remarried, your spouse should also write a will. Number 7, be flexible. Life changes and your will should be adaptable. Number 8, keep your original will in a safe place in a copy at home. This will help you as a copy for your references in the future. Number 9, if you alter your will, prepare a new one or add a codicil. And number 10, select an executor who is willing to do the needs task. Select someone who is willing and capable in handling the necessary task. An example for this one is Lisa and Mario. A married couple prepared their wills together using percentages for their assets and naming their children as beneficiaries. They keep the originals in a safe and gave copies to their family, ensuring clarity and preventing disputes. One of the key things that we have to remember is that a will prepared will safeguard your assets, provide security and peace of mind for your loved ones. Estate tax is not just a tax on the property itself. Instead, it is a tax on the right of a deceased person or transmitter estate to lawful heirs and beneficiaries at their time of death. It also applies to certain transfer that the law treats as equivalent to a will. In simple terms, it is a tax of the privileges of passing on your assets when you die, not on the assets themselves. The tax is calculated based on the laws in force at the time of your death, even if beneficiaries do not immediately receive the property. An example for this one is Mang Juan passes away, leaving a house, savings, and investment for his children. The estate tax is applied to the total value of his estate according to the current laws before his children receive it. Always remember that estate tax is a legal obligation to their heirs. Must consider when planning the transfer of assets, so proper planning can minimize surprises and ensure a smooth inheritance process. Estate tax is a tax on the net estate of a person who has died. Net estate means the total value of all their assets, real or personal, tangible or intangible, minus the allowable deductions. From January 1, 2018 up to today, under the train law, the estate tax is very simple. A flat 6% applied to the net estate at the time of death. Before train, from January 1, 1998 to December 31, 2017, the Philippines used a graduated estate tax table, which means estates were taxed based on the brackets. Estates 200,000 and below were exempted. Estates above 200,000 pesos were taxed using increasing rates of 5%, 8%, 11%, 15%, and 20%, depending on how large the net estate was. Each bracket had a base tax, plus an additional percentages applied to the excess over a specific amount. Here are the exact brackets used the old system. 200,000 pesos to 500,000 pesos is resulting to 5% of the excess over the 200,000 pesos. This continues among the things that are actually written and presented on the chart. For example, under the old law, a net estate of 3 million pesos would be taxed as 135,000 pesos plus 11% of 1 million pesos, which equals to 245,000 pesos. Under today's train law, the same 3 million pesos estate would simply be taxed at 6%, which is 180,000 pesos. The key point is that the date of death determines which tax systems applies, and understanding the rules helps families plan better and avoid unexpected tax burdens. An example for this one, if Mang Juan lives a net estate of 3 million pesos under the old law, the estate tax would be calculated as 465,000 pesos plus 11% of the amount exceeding 2 million pesos, which would be 465,000 pesos plus 110,000 pesos. That will be 575,000 pesos. Another example that we have is under the current law, the same net estate of 3 million pesos would simply be taxed at 6%, which equals to 180,000 pesos. We have to remember that understanding the estate tax and calculating your net estate helps you plan properly. This also reduces surprises for your heirs and ensure a smoother transfer of your assets. The net estate is a portion of a person's estate that remains after certain deductions are made from the gross estate. This is the amount that will be subject to estate distribution or estate tax. Deduction from the gross estate includes standard deduction of 5 million pesos, claims against the estate, or any debts or money owed by the deceased could legally be collected. Claims of the deceased against insolvent persons included in the gross estate, and unpaid mortgages, taxes, and casualty losses. And last, property previous tax. An example that we have is that let's say that the gross estate of Mang 1 is 10 million pesos, and after deducting the debts, mortgages, and other allowable deductions totaling to 6 million pesos, the net estate would be 4 million pesos. This 4 million pesos is what will be considered to estate distribution of the calculating the estate tax. Understanding how the estate is calculated helps you plan properly, reduce tax burdens, and ensure your heirs receive what you intended. Continuing the estate tax and net estate calculation, there are also additional deductions you can apply when computing the net estate. This reduces the amount that will be subject to estate tax. Number 1. Transfer for public use. This includes amounts of property donated in the Philippine government or any of its agencies for public purposes. An example for this one is donating a piece of land to the city to be used as a public park. Number 2. Family home. The value of family's main residence can be deducted up to 10 million pesos. Note that if the home is worth more than 10 million pesos, the excess is taxable. An example for this is a home worth 12 million pesos. Only 10 million pesos is deducted. The remaining 2 million pesos is part of the taxable estate. Number 3. Amount received under RA 4917. These are benefits given to the employer to the heirs when the employees die, such as retirement, separation, or death benefits. An example for this one is the employer gives 500,000 pesos as a death benefit. It can be deducted from the gross estate. And last, number 4, surviving spouse's share. The part of conjugal or community property that legally belongs to the surviving spouse is also deducted. If a couple owns 4 million pesos in conjugal property, only 2 million pesos belongs to the deceased. The other half is automatically deducted. By understanding these deductions, you can reduce the taxable portions of your estate, ensure property estate planning, and protect your heirs' inheritance. Thank you so much.